Hi, everyone. Here we are in Ways and Means again. I hope everyone had a good lunch. It is 1:25 on January 15th, and we are continuing our work to orient ourselves to the tax structure, as well as by learning about the personal income tax today with Legislative Counsel. And in doing that, we are also preparing ourselves for we've essentially two pieces of must-pass legislation every year, which is the yield bill and the federal tax link-up. And so this is one essential piece of our work that we're preparing. Thank you for joining us, Kirby. The floor is yours.
Thank you for having me. Kirby Keaton, Office of Legislative Counsel. A presentation to share with you. Okay, so we're going to talk about personal and corporate income taxes. As the chair mentioned, one of the most important things about this presentation, other than getting you acquainted with different parts of these two tax types, is to let you know about the federal link-up, which will be something that is before this committee at some point this session. There we go. Okay, so what we'll walk through for personal income tax is first the structure, then the structure is really brief, and then the annual link up that we just talked about, some important definitions that are used to put the personal income tax together, some recent changes in Vermont, which relate to mostly with conforming with changes to the federal level. And then at the end, we'll talk about something that's going to be happening at the federal level this year, which is the Tax Cuts and Jobs Act. We'll have many of its provisions expiring at the end of 2025. So first, the structure. So the very basics is that the tax base for the personal income tax in Vermont are based off of what's called taxable income. That definition is located at 32 VSA section 5811 subdivision 21. The tax rates, Vermont uses progressive brackets and marginal tax rates. You'll see this is going along the same structure of the last time I was here and presented on these things. We have a section for that. And then the tax liability, which is things that either add to or come out of the base at the end, such as adjustments and tax credits, and those are mostly in subchapter 2 of chapter 151. Chapter 151, for those who are new to the committee, is the income tax chapter. It's a very large chapter in Vermont statutes. So the link up. So understanding what the link up is about, it helps to understand just how laws are crafted and drafted. Oftentimes, not just with this, but with other things, there'll be a few sentences or a few words in statute that incorporate by reference a whole other big area of law. So the federal link up is an incorporation by reference of the whole area of federal income tax law. And then Vermont deviates from there. But the starting point is through the link up and starting with federal law. Specifically, every year when we do the link up, we link it to federal income tax laws of a certain date for December 31 of that year to apply to the applicable tax year, the current tax year. This is what the section looks like in Vermont law. I won't bore you with reading it, but there it is. And that's what gets changed every year. You'll see in this case, the version of it I have says 2023. That 2023 number is what gets updated to a new number. Okay. Pretty much went through this already. This is what it looks like in bill form when you see it link up. this language has to not withstand 1 VSA section 214, which is the section of Vermont law that prohibits retroactive effective dates for laws. You'll see that a lot in the tax world. It is an area in which we need to do things retroactively in order to start a tax at the appropriate time. In this case, again, basic stuff about how income taxes are done. But when you pay your income taxes in 2025, this year, in the spring, you're paying them for 2024. So it's tax year 2024. Okay, so that's the basics of the link up.
Just on tax year 2024, I just want to call people's attention to this really lovely chart here. If anyone has time at some point to look at it, it has tax years, years, education years. They're all different. And so it's nice to just have that there as a resource for every minute. Back to you.
Okay, so breaking down the income tax and how we get to where we are in Vermont, we start with federal law because of the link up. Federal law starts with gross income. That is all forms of income, including wages, tips, salaries, commissions, rent, royalties, interest. I think you get the picture. Anything where you're bringing in any type of income from anywhere. There's only a few things that are excluded from that, and that would be some Social Security income, interest on state or local bonds, and then the cancellation of certain student loan debt. I can happily say that a few years ago, I had my student loans forgiven because of my public service at the federal level. And when that happened, I did not report any of that forgiven debt on my federal return. When it's not part of gross income like this, it's not reported at all. It does not go on the federal form. So what does go on the federal form, you start with the gross income, and then that is adjusted with certain exclusions and deductions to get to adjusted gross income, AGI. So examples of common federal adjustments to gross income, you have teachers' expenses that come out, you have IRA deductions, student loan interest, tuition and fees. These are the types of deductions or income that ends up getting excluded that are not itemized deductions, if you're familiar with that. These get deducted at the federal level to get to AGI before you're at the stage in which you're taking any itemized or standard deduction. Also called above the line deductions. And that's probably some jargon you'll hear again, above the line deductions. So there's other adjustments made here. I won't read you all of those, but if you need to see other adjustments that are made to AGI or to get to AGI, there they are. So at the federal level, still we're at the federal level. You take AGI and then you have your standard deductions, you have your itemized deductions. And after subtracting those things out and any other miscellaneous deductions, you get to federal taxable income. So Vermont taxable income is different than federal taxable income because there are certain things that are taxable at the federal level that we can't tax, such as railroad retirement income or anything that would be discriminatory tax treatment of federal source income in favor of state source income. An example of that, if you're wondering what that means, is the General Assembly here could not pass a law that said that we are going to tax federal employee retirement, but we are not going to tax state employees retirement. So that's precluded at the federal level. So federal income tax definitions, gross income, this is just a review, minus the above the line deductions. It's adjusted gross income. And then that's where Vermont picks up, and Vermont income tax law picks up with the federal adjusted gross income. So when people file taxes here, they take their federal 1040 adjusted gross income, And then in Vermont, we automatically add some things to adjusted gross income. Now we're not in the link up area anymore where we're using federal law for things. We're now in the green books and the changes that our tax code makes to the system. So in our green books, we have in Title 32, Chapter 151, we have the addition of what's called bonus depreciation, interest from non-Vermont state and local bonds. Those things are added back. They're not taxed federal level, but they are here. And then Vermont makes its subtractions from adjusted gross income. Key here is we're not going off of federal taxable income. We took a step back and used federal adjusted gross income to get to our own taxable income. So at the federal level, for instance, you have standard deduction. At the federal level, that does not flow through to Vermont. Vermont has its own standard deduction. I have the numbers there for 2024 for the standard deduction, for the personal exemptions you can take in Vermont. And then there's these other subtractions to get to taxable income in Vermont. Interest income from U.S. bonds, Vermont has its own capital gains exclusion, has its own social security exemption, and exemption for medical expenses, or deduction rather. And then we get to Vermont taxable income for a person.
Just real quick, so on, yeah, that slide there, the standard deduction and the personal exemptions qualify for both?
In Vermont, yes, you can take them. Yep.
Thanks.
Currently, I don't know, you're not asking just to elaborate me, but at the federal level, they don't have personal exemptions currently under the Tax Cuts and Jobs Act. Okay, so brief history of the changes to the tax base here in Vermont. So prior to 2002, to give you just a timeline of how things have developed for the personal income tax. Prior to 2002, our personal income tax base was a percentage of federal taxable income. So a lot more of leaning on the federal tax code and just working right off of it and letting a lot of stuff flow through. And then in 2002, Act 140 amended the starting point to be just federal taxable income, which opened the door for 15 years later for Vermont to change again to have the starting point for the personal income tax to be federal AGI, which is where we are now. This 2017 change was around the same time as the Tax Cuts and Jobs Act, which we'll get into, which caused Vermont to decouple, so to speak, from the federal law quite a lot. So then we have 2018, this is after Tax Cuts and Jobs Act. Act 11 made further structural changes to the base. So what happened with the Tax Cuts and Jobs Act, which was enacted December 22nd, 2017? So the most significant things at the federal level were elimination of personal exemptions, which I just mentioned, doubling of the standard deduction at the federal level, which was to encourage people to take the standard deduction and to not itemize, and the alteration of numerous itemized miscellaneous deductions. Most of these were effective through tax year 2025. So at the end of calendar year 2025, a lot of these are set to expire. Spoiler, Congress is probably going to have a tax bill this year and make a lot of changes. And who knows what the future holds, but except that there will be changes and there will be a lot of consideration of what things out of the Tax Cuts and Jobs Act does Congress want to keep and not let expire.
And so if they're not able to act, there will be changes because there's a sunset. And if they are able to act, there'll be changes because they acted.
Yes.
Okay, so change no matter what.
We can expect a lot of change for income taxes in this calendar year at the federal level.
Representative.
You have Vermont's response, and then as a result, fewer federal income tax changes flow through to Vermont. Do you have a list of those, or is that just so long, or what?
We'll be going through in the presentation the major parts of it. Yeah.
Thanks for queuing him up. Thanks for queuing him up.
Oh, yeah.
Yep.
No problem.
So yeah, the next few slides will be those things exactly. So let's take a look. So the big one was Act 138 in 2022, an act relating to Vermont child tax credit and the Vermont Social Security income exclusion. What Act 138 did was create a refundable $1,000 Vermont child tax credit for qualifying children 5 and under. This is decoupling from the federal versions of these things and creating a Vermont specific one so that changes at the federal level will no longer affect Vermont for these things, right? So that the bill also, or the act also phased out for taxpayers with AGI over 125,000, or this credit phases out for AGI over 125,000, so that by the time a person's AGI is 175, they're not eligible for the credit anymore. There's a Vermont Child Independent Care Credit, which was expanded to be refundable credit that is 72% of the federal Child Dependent Care Credit. So again, leaning on federal law for establishing what the amounts are, but having a Vermont specific version of it. And then there's a Vermont Earned Income Tax Credit, which was expanded to 38% of the federal Earned Income Tax Credit. This isn't, I mean, Vermont already had that, but the amount was increased. There's now a Vermont student loan interest deduction. It phases out similar to those other credits. Vermont also expanded its Social Security benefits exemption by $5,000, and it added a new $10,000 retirement income exemptions. So both of these are partial exemptions relating to retirement income.
And for folks who don't remember, these were at the time and maybe still one of the largest child tax credits, the largest EITC, one of the larger child independent care credits in the country, and was a bipartisan move that was quite exciting. And then I've also recently talked to people who have been in the building for a long time who didn't seem to know about them. And so it wasn't that long ago. So let's still be celebrating that good work for another 5 minutes at least.
Okay, so now we're at the part that we're leading up to, which is that this is expiring, right? So many of the provisions are set to expire, like I mentioned before. If you're curious at all about why it was structured this way at the federal level, a lot of it had to do with this thing called the Byrd Rule, which the Tax Cuts and Jobs Act used what's called a reconciliation process to get the act through Congress in a more streamlined way, in a way that was easier to pass in the Senate. But when you use reconciliation, there's something called the Byrd Rule, which puts requirements on doing it. And part of the Byrd Rule is that certain bills, or these bills using reconciliation, can't raise the federal deficit beyond a 10-year budget window. And that's why we have sunsets for so many of these provisions. I'm sorry if that was too in the weeds.
No, I loved it. I mean, I'm sorry for anyone else. That's great.
Okay. So here are some of the things that are not going to affect Vermont greatly because Vermont has decoupled already with some of the expiring provisions. The federal marginal rates for the personal income tax rates will revert to levels from before. So it's going to revert to 39.6% at the highest rate, down from 37 or from currently being 37. The federal standard deductions refer to pre-Tax Cuts and Jobs Act's level, which will be slightly higher than half of what the standard deductions at the federal level are right now. The federal child tax credit will revert to $1,000 per child. It's currently at $2,000. And the income threshold will decrease to $75,000 of taxable income, or I think AGI, for single filers and $110,000 for joint filers. And then there's other itemized deductions that are being changed, such as the mortgage interest deduction is going to become more favorable to the taxpayer, and the charitable contribution deduction will also be more favorable to the taxpayer.
Yeah.
At federal level.
So you've done a lot of work on these issues in other committees. Is there a way to pull together? I mean, I'm thinking of things like the child tax credit, which research suggests is one of the most effective tools for combating child poverty. Is there a way to pull some of this together so when we understand, when we look at this, we have references that are available to us to do this? Because this also is going to intersect with things like the education fund.
Yes, let us
So you
like.
go, I just don't want to retread ground that you've already tread.
Well, it's really helpful. It's a really helpful question. Let me talk to staff and figure out a way we can do that.
You can also assign us to go back and pull some of this.
Rebecca, would you like to go back through all of that?
Only on issues like
Why don't you start there? Why don't you start there and we will figure out what you're missing.
Give you a hard time, sorry.
Thank you. No, I appreciate it. Would anyone like to work with Rebecca on?
Sure.
Okay. Okay, great. Thank you both for your extra research.
Okay, so what does affect Vermont? There's currently a $10,000 salt cap deduction or salt deduction cap that affects Vermont, and it no longer, or is set to expire, this cap at the federal level. I'm going to try to pull up my notes without affecting anything here. Okay. So the salt cap deduction is it puts a cap on how much a taxpayer can deduct at the federal level for state and local taxes that they paid. And it was seen as more punishing to blue states because those states have higher state and local taxes, and so therefore the people living there are paying more of those taxes. And so putting a cap on how much they can deduct at the federal level punishes people living in those states more. I mean, maybe punishing is not the right, phrase there. I probably could have phrased it more diplomatically, but I think you get the point.
Increases their liability.
Increases their liability at the federal level.
Okay.
Again, what salt is.
State and local tax. And I do have an image of like a salt shaker in my mind when I see that, even though it's nothing to do with it.
Representative Odie?
Thank you. And just any of that tax revenue, I think I know the answer to this, but I'm gonna ask you. Go to the state of Vermont or just go to the federal government?
This tax revenue, basically the extra tax
extra
revenue
tax.
generated by this cap is federal taxes.
So it doesn't stay in Vermont. Doesn't help Vermont.
No, it just means that some Vermonters who would be able to deduct more than 10,000 aren't able to do so.
Do you know how much left the state over all the years with this salt?
I don't.
There was an effort, what was it, 2 years ago?
Every year.
Okay, I withhold the question.
No, ask the question.
No, but it was to change the taxes so that it would be more favorable for Vermont taxpayers who had a greater than $10,000 state and local tax deduction, right?
Yes, it's
Never went
have
anywhere.
around.
Yeah, salt cap workaround, and I'm trying to remember how that worked or what the proposal was, and maybe that's for a different time. But it seems to be relevant to that deduction expiring at the end of the year if nothing happens, but I can't imagine the current administration would allow that to expire, but I don't know.
I think what it I mean, on some level, what it means is that if it does expire, that conversation about whether or not to pass something
Goes
to
away.
apply to it goes away.
Right, but I think it'll probably be
Yeah.
renewed by this administration.
I feel like we can't assume anything about the federal dynamics right now and anyone's ability to pass anything. I don't know. Representative Maslin.
Yeah, I should know this question, but Kirby, you can help answer. So given the fact that it'll take Congress a year maybe or something, who knows how fast they'll work to work through changes or whatnot, what can we expect? Yeah, let me rephrase that. Given that it'll take Congress a while to work through whatever they're gonna do, what should we be aware of in terms of immediate changes, meaning short-term changes, or maybe it's gonna take them a while to figure it out? Did I get on that?
For personal income tax, I'm not sure there's anything urgent unless they pass something new that affects Vermont and it takes effect before, you're able to react next session. I think that would be something to think about, and to keep an eye on. There's some corporate income tax stuff we'll get to a little later that
Okay,
might affect Vermont more.
sit tight and hold on, something like that.
Yeah, I think it's,
Thank you.
do what you're doing, what we're doing right now. Okay, so that's it for the personal income tax, unless there's more questions about things.
And what we're gonna do in terms of going through this material is we're gonna hear from Kirby on both the personal income tax and the corporate income tax, both income taxes. And then at a separate session, we're going to hear from Pat from JFO about personal income taxes and corporate income taxes, probably as separate chunks of testimony. And so there'll be a second chance to go deeper into both of these.
Yeah, and Pat will bring numbers. I'm just not able to bring you.
You bring the words.
All right. He brings words too, but, okay, so corporate income tax. What's in store here is, we'll go through the structure and the definitions, then some recent changes like we did before with personal income tax, and then we'll talk a little bit about Tax Cuts and Jobs Act expiration. And I'll tell you right now that, I've excluded foreign income and things related to the taxation of foreign income from most of that from this presentation, because there's some larger changes happening internationally, not just with U.S. federal law, and so we'll have to revisit that later, and that's when we'll tackle some of the taxation of foreign income stuff that I would have talked about here. Okay, so the corporate income tax structure. The tax base is off of what's called Vermont net income.
Can you back up? What's a corporation?
Those are actually like always the trickiest when you're like in the ledge council seat, like wait, you mean something basic you want me to talk about? So for purposes here, it's well, actually, I think I have a slide.
Sorry.
Yeah, you want to talk about when we get the slide in a minute?
I think to start with who we're talking about. So yes, can you start with
Okay.
that one and then go back and then go back again?
So corporations, it's an incorporated entity, with a name like Inc. or Corp. It's a legal entity that has to be established, right? With shareholders and with an entirely different tax process. I think it's maybe easier to understand it when you juxtapose it with other entities that are not corporations, something like an LLC or a partnership. Those are not corporations and they're not tax-like corporations. Those are other types of entities. I'm not a corporate lawyer, but a lot of stuff comes with being a corporation, right? About such as the officers of the corporation become shielded from liability from things in a way in which a person who's just running a business as a sole proprietor might not be. Corporations have shareholders, which partnerships, LLCs, things like that. would not. Does that help? Okay.
So that a sub S corp is taxed differently, so a C corp is taxed at a separate entity level.
Yeah, we are talking about C corps here. S corps are, the tax treatment's a little different. Some of them can be taxed as C corps in Vermont, but not always. Okay. So let's start over with the tax base.
Thank you.
Vermont net income is defined in the green books. Vermont uses, similarly to the personal income tax, uses progressive tax brackets and marginal tax rates. There's a minimum tax based on Vermont gross receipts. And the tax liability is decided through a mechanism called allocation and apportionment, which we'll be getting into here. So who pays the corporate income tax? To be clear, it's only US resident corporations. So individuals, pass-through businesses like LLCs, partnerships, do not pay corporate income tax. Foreign corporations to have no dealings with Vermont would not pay Vermont corporate income tax. So as we said a minute ago, US resident C corporations, incorporated entities, it's the corporations as separate legal person, which provides shareholders protection from personal liability. The reason why they're called C corporations, if you're wondering, if it ever comes up at trivia night, is this subchapter C of the Internal Revenue Code. It's not just because, I would have assumed it's because it's corporation, right? And the corporation starts with a C. Maybe they did that on purpose, but technically it's because it's subchapter C. Corporate income tax is imposed on the entity. It's not imposed on individual shareholders. This is different than pass-through entities, where taxes is imposed on the members of an LLC. Corporate income tax is imposed on the entity. I already said that. So the shareholders will then pay personal income tax on the dividends and capital gains and on the appreciation of their shares from being a shareholder in a C corporation. So that would be in addition to corporate income tax. And the reason why, one of the main reasons why C corporations exist is that they're able to raise money on public markets by being a C corporation.
But you said shareholders pay on, essentially, I think you said, increase in value. But that's when they realize the value, right? It's not the market says kind of stuff, right?
It's a lot.
Does that make sense the way I phrased it?
Yeah, so it's what capital gains they receive from their shares.
Right, right,
It's what they're taxed on.
but not just holding on to stuff. Okay, thank you.
Yeah, that's true. I understand the confusion there.
Okay.
Because I think the reason why in that sentence it says appreciation of shares is when you sell it, it's the depreciation is the profit you
Okay,
make.
thank you.
Yep. Okay, so who does not pay corporate income tax? I think we've already talked about a lot of this. Individuals and pass-through businesses do not pay. Partnerships, limited liability companies as corporations, sole proprietors. Those are all taxed through the personal income tax.
Can you give an example of a pass-through business? What do you mean by that?
Yeah, so in the tax world that we're in now, an LLC is a pass-through entity. Why it's called pass-through is that the LLC will have income and it will go to the members of the LLC, which are the individual humans. And those people will, the taxation part of it is passed through. It passes through the LLC, that's why it's called pass-through, to those individual people who then file their personal income tax return. And then that's where they pay the income received from the LLC. The taxation of it kind of passes through the entity itself to the people, to the
So it gets
individuals.
paid as an income, as an individual income tax as
Mhm.
opposed to a corporate income.
Yeah.
This is a really important and detail because I think generally when people talk about like business taxes and not business taxes, they're not talking about corporate income taxes and personal income taxes.
Mm.
And so it's help, and we'll, hear more from Chris on this about how sort of it shakes out. But it's just, for me, it's really helpful for me to be thinking that a huge number of businesses in Vermont are actually paying their business taxes as their income taxes, because they're income that the business owner receives. And the corporate taxes is a fair smaller portion of the whole thing. Yeah.
Mhm. Okay. So what is Vermont net income? So this is what's taxable in Vermont. So net income starts with federal taxable income. This is again, piggybacking on, the federal corporate income tax. And then there's plus or certain minus items of income, that's in the green books. Just like the personal income tax, right? Vermont does not allow deductions for what's called bonus depreciation, which, in a nutshell, the bonus depreciation is, let's say a business buys some machinery, and at the federal level, they're able to deduct from their income over time as that they spent money on the machinery and then the machinery becomes less valuable. They're actually able to deduct that depreciation, the value of it over time, but bonus depreciation lets them deduct a whole lot of the value in the first year, right? So bonus depreciation, non-Vermont bond interest, federal operating losses. So Vermont's not allowing those deductions. But Vermont does allow deductions for certain income added at the federal level related to foreign credits and job creating credits. And then Vermont allows cannabis businesses to, those that are C Corps, or LLCs electing to be C Corps, or to be taxed as C Corps, to deduct business expenses in Vermont, because the federal laws don't allow that because those businesses are doing something illegal. Okay.
By federal standards.
Under federal law. So federal taxable income is a corporation's receipts minus allowable deductions. So this is just to let you know what goes into federal taxable income. It's the cost of goods sold, wages, and other employee compensation expenses, interest. So the second bullet point are the allowable deductions. And I'm not sure if anyone's going to ask this question, but I mentioned, I'll get out ahead of it anyway, just as I don't know, this is definitely not gonna come with trivia, I don't think, but we'll throw it out there anyway. I mentioned an LLC electing to be taxed as a C Corp, and you might ask, like, why would they do that? This could be a reason why, if you're a large enough LLC and have a lot of employees and you provide benefits for those employees. That's one area where I'm aware of LLCs sometimes wanting to be taxed as C corporations so that they can deduct these expenses. It might be in their interest to do so. The tax rate structure in Vermont is pretty simple as far as tax brackets go. You reach the top marginal rate of 8.5% pretty quickly. Anything over 25,000 in net income that is allocated and apportioned to Vermont. And we'll get to what that means in a minute. Vermont also has a minimum tax, I think we mentioned before. Minimum tax applies to all active corporations, and it's based on the amount of the corporation's Vermont gross receipts. So it can be up to 100,000 if there's over 300 million in Vermont gross receipts. Minimum taxes exist partly because through accounting and so forth, some businesses are able to, on paper, make it look like they don't have a lot of profit, while their actual gross income is very large. So that's one reason why jurisdictions will have a minimum tax.
4% Maslin? And then Woody?
I've heard from constituents, and you may now from time to time, that our corporate minimum tax is too much. And we've made some progress on reducing that a little bit. Probably not a lot for enough people, but every time we reduce the tax somewhere, we have to make up the money somewhere else. And we've made a little progress. I just keep that in mind. It may come up again from time to time.
We reduced it for the lower brackets a couple of years ago.
Yeah,
4% Woody?
I was gonna say, I think we should celebrate that. We're talking about celebrating, and we did lower taxes for corporations that are small.
Thank you. Do they thank you?
No, no.
I think just about as much as we lowered it.
We did lower it.
Kirby, back to you.
Sorry.
Okay, so I've been throwing these terms allocation and apportionment out a little bit. Let's get to what that means. If you remember from the first slide, allocation and apportionment is how the tax liability is assigned. So multi-state corporations typically have complex structures, right? A lot of the time there's a parent corporation and subsidiary corporations under that. They're receiving income from a lot of different taxing jurisdictions, other states, other countries. So when a C corporation's income is derived entirely from within Vermont, that's the easiest return for us, right? Because it's all Vermont net income and it's all allocated to Vermont. I would suspect that there's almost none of those. But what's much more common is when a C Corp's income is derived from both within and outside Vermont. And so Vermont law has to apportion the corporation's income that is allocated to the state using formula. Before I tell you, I didn't realize how much this presentation is sort of like teasing because
It's
I
thrilling.
still haven't told you the formula, have I? And before I even do that, I'm going to say, well, let's stop and let's talk about the history of the formula. Here's the history because it has changed recently. Apportionment formulas looked at this is basically across all states, right? Each state had decided how it was going to try to apportion things. There's no set standard way. So historically, other states, including Vermont, have looked at property, payroll, and sales as different ways to measure how much activity this corporation is doing in my state. The recent trend has been to move away from property and payroll and to move towards what's called a sales factor. In case this is confusing, if you look at property, you're looking at how much property that corporation has in your state compared with other places, right? If you're looking at payroll, you're looking at how much payroll, how many employees, or the corporation has in your state compared with other places. And then sales is how many sales are made into your state compared with other places. So many states count sales factor twice or more, so double or triple sales factor, but in those cases, property and payroll would still be factors. More recently, states, including Vermont, as of 2023, have moved to single sales factor. So that's where Vermont is. We only look for purposes of allocation and apportionment, we are only looking at sales into Vermont using Vermont as a market. So if a corporation has a headquarters property in Vermont and employees, but happens to only make sales to other states, then we're not apportioning or allocating income to Vermont.
So there's a big contractor in the Essex area that you might think of that would likely be, I mean, I have no idea what their taxes look like, but I would imagine that they're not making sales into Vermont. And they have lots of payroll and property here, so they would not be paying Vermont corporate income taxes.
It's attractive for some company that wants to export from Vermont, if you say export loosely.
What was that a question? I'm sorry.
No, rhetorical.
Okay. So we're on to Tax Cuts and Jobs Act. What did it do at the federal level? It moved from a modified worldwide system for deciding a tax liability to a territorial system, which means that the US has moved more toward basing its taxes off of domestic rather than trying to reach out and get tax foreign. But then it did other things to account for foreign income. It's allowed repatriation of profits, which and to decrease corporate income tax rates. Repatriation of profits is basically the Tax Cuts and Jobs Act did some things to encourage businesses to move their activity back to the US if they've moved out of the US for tax reasons. It has some things built into it to try to encourage those to come back. But the rates being decreased are just the rates being decreased, which is what they did. It changed it from a 35% top rate at the federal level to there's now a 21% flat rate at the federal level. And we'll get to the expiration in a minute. Tax Cuts and Jobs Act also eliminated the tiered corporate income tax rates and the 20% corporate alternative minimum tax. Vermont's response here was, when it came to the rates, there was no response because Vermont was already decoupled from that. When it came to the income, Vermont's existing definition of corporate income was sufficient to capture one-time federal revenue changes, such as the repatriation of certain deferred foreign profits. Okay. We also recently had the Inflation Reduction Act, which was enacted in 2022. At the federal level, they created a 15% corporate alternative minimum tax, also called a book tax. It applies to the adjusted financial statement income for corporations with profits of more than 1 billion. And it's effective starting tax year 2023. So a minimum tax at the federal level. It also created a 1% excise tax on the fair market value of corporate stock buybacks. There was no impact on Vermont with these changes. It's not something that Vermont piggybacks for either of these things. So what has Vermont done as far as corporate taxes to respond to changes at the federal level? There's Act 148 of 2022. As I mentioned before, that's when Vermont changed to the single sales factor. We all know what that means now, right? For the apportionment and allocation stuff, we changed to single sales factor.
Joyce to Finnegan.
Joyce to Finnegan's fund. Joyce to Finnegan has to do with how Vermont decides jurisdiction for a corporation, like a subsidiary. Under Joyce, which is what Vermont used to follow, it would look at each individual subsidiary and whether it had business activity in Vermont to decide whether they owed tax in Vermont. Under Finnegan, which is now the law for Vermont, if any subsidiary of a larger group of corporations has activity in Vermont, it means the entire group is at least considered on the return for Vermont. But then you go through the allocation and apportionment stuff we talked about to get at what the tax liability is. But the whole group is on the return though.
Just, if there was a quiz on this, I probably would not get a very high mark, I'm sure. But we did make an effort to try to, treat businesses subject to these taxes and encourage them to do their business in Vermont. I mean, it was basically, come on, folks, do your work here. You're gonna be better off the way we're structuring this, the way we had it previously. Excuse me, Greg Bolio or someone can tell us to what extent we've been successful.
If we've been very successful.
It's just.
My understanding is that we did not do a great job making sure that the Agency of Commerce was aware of the tax changes we did. And so it sort of came to light last year that there were a number of corporations in Vermont that hadn't realized about these changes. And so I think that is something that we could maybe give some thought to this year. Yeah. And we're going to go deeper into all of this with Pat as well. So if like first glance, all of these terms seem a little overwhelming, we're going to keep on climbing back to them.
I think this slide right here that we're on is the densest. This plus the apportionment allocation stuff that we just talked about. That's the densest in this presentation. We talked about Joyce to Finnegan. Act 148 also repealed the 80-20 rule, which has to do with income from overseas corporations. What it did, it's gone now. But when Vermont did follow the 80-20 rule, that was if a foreign entity conducted at least 20% of their business in the US, then they were included on a return. But in the 80 part of this, you would exclude domestic corporations, US corporations that conduct at least 80% of their business outside the US. And we replaced that with the system that we have now. Same thing with the throwback rule. The throwback rule was when a sale, this is for determining nexus, whether a corporation has to pay in Vermont, right? And so when a sale was made to a state that can't tax the sale would be assigned back to Vermont as the source of the sale. So a throwback. Vermont doesn't follow that anymore. But Vermont did create the new minimum tax brackets and the amounts for those at that time. So Act 148 was a real light read. Okay.
And if anyone does, I have the floor report from that. If anyone wants to read it, would certainly be slightly more readable than the statute, but not significantly more readable.
We're gonna dig further into it.
We're likely not going much further into it this year. So this is just like, we're in understanding how the tax system works because we're the tax committee.
Okay.
I personally don't have grand plans for revising any of it.
Okay.
Yes. So what might be happening with the Tax Cuts and Jobs Act expiring? One of the things that's not expiring, I talked about the Byrd rule made it so that a lot of these provisions sunset, but one thing that's not sunsetting is that the federal corporate rate is supposed to stay at the 21%, the flat 21%. That does not affect Vermont, obviously, because we have our own rate. What is expiring is that pass-throughs can no longer deduct up to 20% of qualified business income. So that's sunsetting, and there are certain business expenses that are expiring, like the bonus depreciation that I mentioned before, R&D expenses and business interest deductions all of those things are expiring at the federal level. And then this is the last slide for me. There's some changes happening at the international level. There's something called Pillar 2, which was a large international agreement that's been in the work for a while now, that has very many countries signed on to it to create a global minimum tax rate of 15% for corporations. It's going to affect the US even if the US doesn't agree and sign on to it. Currently, the US is not. And as far as I know, I don't think there's any reason to expect the US to sign on to it. But US federal tax laws will have to acknowledge that it exists and be compatible with this landscape internationally of this 15% minimum tax rate and what it's trying to achieve. One of the things it's trying to achieve is to avoid corporations running into tax havens. And so Congress, through the Tax Cuts and Jobs Act, did some things to try to prevent tax base from fleeing the country. At a later presentation, I plan to come back and talk about, if it's of interest to the committee, what Congress did with the Tax Cuts and Jobs Act to do this, something called GILTI, Global Intangible Low Tax Income. We talked about it last year in here. It was a lot of fun for those who were around. This stuff's never fun for me. It's not my area, so. And like imposter syndrome, like I don't know. Anyway. So there's GILTI, there's there's all sorts of stuff that Pat would love to talk about though, with foreign income. And then there's this Pillar 2 thing, and then there's the provisions that are expiring with the Tax Cuts and Jobs Act. Pillar 2 has something called a safe harbor, where.
Do you want to show that screen? You haven't advanced to that.
Oh, I'm sorry. Thank you very much for that.
Let's try.
I didn't realize that I was looking at a different screen. This Pillar 2 agreement has a safe harbor that will expire December 31st of 2026. So in a way, Congress will have 2 years, although we know that they will be responding this year, most likely, to Tax Cuts and Jobs Act expirations. So they may respond this year to Pillar 2 being a thing. It's going to start impacting US corporations after that safe harbor ends in 2026. There are some conflicts with what they did with the Tax Cuts and Jobs Act, with this GILTI thing that I mentioned before, and some other things that don't really match up with what Pillar 2 is doing. So more to come on that, but there's changes that are happening, and there's changes that have happened that I'd like to get you more caught up on.
Does anyone have any further questions for Kirby? Yeah, Representative Brennan.
Do you have time, Mikhail? Because I have a question about all these companies in Ireland, that they're American companies in Ireland, which apparently hadn't been paying their full obligation for tax over there. So they were paying it over here, and that somehow wasn't fair. So now Ireland is enforcing the tax regulations, and so they all want to get out of Ireland. What do we do to attract them here to Ireland?
Oh,
And I thought briefly that Justin Finnegan thing was related to that, but I don't think it is.
It's a big, that sounds good.
That's very nice.
Name only, but that's a joke.
I think that's a great policy question to, I don't know where to begin, though, to talk about how to attract Irish.
They're trying to kill.
Right.
He's got to think about it.
Does
Yeah.
anyone have any more technical questions for Kirby about the presentation? Okay, I hope everyone's brains are exploding a little bit. We are done for the day. We are going to go deeper into this all with Pat, with numbers and examples and such soon. And we're supposed to always wrap up 15 minutes before the floor, which is a weird adjustment for me inside my head, but I'm going to do my best, and we're succeeding today. So we will see.